Do you ever wonder why so many people work hard, only to still feel stuck, stressed, and one emergency away from financial trouble? It's not because they're lazy or lack talent. The truth is, they were never taught how money works in the real world. Schools focus on grades, tests, and career paths, but they skip the lessons that shape how you manage your money for the long haul. In this video, we're diving into the top 8 lessons learned from past economic crises. These are not complicated formulas or risky shortcuts. Instead, they're practical, easy-to-understand principles that can help you build financial security, even when the economy feels uncertain. Let's jump in. 1. Have your liquidity planning correct. One of the most important lessons from past financial crises is the importance of liquidity. It's tempting to invest everything for growth, but during tough times, having accessible, risk-free cash on hand can be a lifesaver. Keeping a portion of your assets in liquid, short-term accounts, like savings accounts or bonds, allows you to weather unexpected storms without having to sell investments at a loss. When markets drop, the last thing you want is to be forced to sell your stocks or bonds at a loss just to pay for an emergency. Having a cash cushion helps you avoid these scenarios, giving you the flexibility to stay invested for the long term. Whether it's saving 3 to 5 years of living expenses or just ensuring you have emergency funds, the lesson is clear. Liquidity is your safety net. So, when the markets are unstable, don't put everything into long-term assets. Keep enough cash available to handle life's unexpected expenses, giving you the freedom to make decisions without the stress of having to liquidate your investments. 2. Transform a downturn into an opportunity. Every downturn in the economy presents a unique opportunity to reassess and improve your financial strategy. While recessions and market drops can be unsettling, they also provide the perfect time to refine your financial plan. Whether it's reevaluating your investment portfolio or exploring new business opportunities, a downturn offers the space to pivot and strengthen your financial position. The key is to avoid panic. Instead of reacting impulsively to market dips, take the time to strategically adjust your investments. Consider shifting towards more defensive assets or even exploring opportunities to invest in undervalued assets. A downturn can also be the right time to focus on your business model or diversify your income streams, strengthening your finances for the future. By transforming a downturn into a chance to make adjustments, you position yourself to take advantage of the recovery, ensuring long-term success and resilience. 3. Don't overcorrect. It's natural to feel the urge to make drastic changes to your financial strategy when the markets dip. However, one of the biggest mistakes people make during tough times is overcorrecting, whether it's moving too much into cash or making extreme adjustments to your portfolio. In past crises, those who reacted too quickly found themselves missing out on the subsequent market recovery. Instead of overcorrecting, make small, thoughtful adjustments to your strategy. This might mean diversifying your portfolio to include more defensive assets, like bonds or dividend-paying stocks, but it doesn't require abandoning your long-term strategy altogether. Remember, the market will eventually recover, and being overly cautious could mean you miss the growth when the economy rebounds. Staying calm and sticking to a well-thought-out strategy is the best way to ensure that you don't make decisions based on fear or short-term emotions. Keep your eyes on your long-term goals and trust that your strategy will pay off in the end. 4. Be on the offense when it comes to prospecting for new clients. During tough economic times, it can be easy to hunker down and wait for the storm to pass. But for those who thrive during economic uncertainty, it's important to stay proactive. Financial advisors, for example, have learned that market downturns are the perfect time to bring in new clients. If you're an entrepreneur or freelancer, this lesson applies to you as well. You need to continuously prospect and seek out new opportunities, even when things seem slow. While the economy may be in a downturn, people are still looking for solutions to their financial problems. Offering your expertise, whether it's through consulting, financial services, or your business, can help you diversify your income and increase your client base. During slow times, the proactive approach will set you apart from competitors who are waiting for things to improve. 5. Don't underestimate the value of service. In times of uncertainty, clients and customers need more than just a product. They need consistent, reliable service. Financial advisors who thrived during economic crises were those who kept communication open with their clients, offering proactive advice and ensuring they were always available to support them. For businesses, this lesson is crucial. During times of crisis, your clients want to know that you're there for them. Whether it's offering guidance, responding to their concerns, or providing additional services like budgeting or debt management, the value of good service cannot be overstated. Being available, helpful, and proactive strengthens relationships, builds trust, and secures client loyalty. 6. Move the conversation away from numbers and toward the financial plan. In times of financial uncertainty, it's easy to get fixated on numbers, whether it's the daily stock market fluctuations or the constantly changing value of your assets. While it's natural to pay attention to these, the real focus should always be on your financial plan. When markets are volatile, financial advisors and individuals alike benefit from shifting the conversation away from short-term market movements and toward long-term goals. This approach not only helps you maintain perspective but also keeps your emotions in check, preventing you from making rash decisions based on fear or panic. Rather than obsessing over daily losses or gains, take a step back and refocus on your overall financial strategy. Ask yourself, what are your long-term objectives? What are your retirement goals? How are you managing cash flow and ensuring consistent savings? By keeping your attention on the bigger picture, you reduce the anxiety that comes with the daily fluctuations of the market. Remember, the stock market will have its ups and downs, but it's the long-term plan that will ultimately determine your financial success. Staying aligned with your plan during times of volatility ensures that you aren't reacting emotionally to every shift. It helps you stay on course and make well-thought-out decisions, even when things get tough. This mindset not only protects your finances but also strengthens your confidence in your long-term strategy, ultimately allowing you to weather financial storms without losing sight of your goals. 7. Education is key, especially now, when there's a lot of noise out there. In times of financial uncertainty, it's easy to get overwhelmed by all the conflicting information and noise. From social media to news outlets, it feels like everyone has an opinion on what's going to happen next. But the best investors and financial advisors are those who focus on education. They take the time to understand the market, learn the basics of investing, and stay informed about changes in the economy. The more you educate yourself about your finances, the better you'll be at making informed decisions, especially during times of volatility. Instead of relying on fear-based news or sensational headlines, turn to trusted sources and invest time in understanding financial concepts. The more knowledge you have, the better equipped you'll be to make smart financial decisions, no matter what the economy is doing. 8. Have a communication plan in place before you need it. When markets become volatile, communication is key. During the financial crisis of 2007 to 2009, many financial advisors were caught off guard by the speed at which the markets changed. Those who were prepared with a communication plan in place were able to reassure clients and provide proactive advice. Having a pre-approved communication strategy helps alleviate stress and keep clients informed during periods of uncertainty. In personal finance, this means having a plan in place for when an emergency happens, whether it's a job loss, a market downturn, or a sudden expense. Knowing how you'll respond ahead of time ensures you don't make hasty decisions or feel panicked when the unexpected occurs. By staying calm, having a plan, and communicating effectively, you protect yourself and others from unnecessary financial anxiety. The lessons from past economic crises are invaluable. They not only help you understand how to navigate tough times but also offer insights into building long-term financial resilience. By focusing on liquidity planning, maintaining good service, educating yourself, and sticking to your financial plan, you can face any economic downturn with confidence. If these lessons helped you see personal finance in a new light, like this video, share it with friends or family who need to hear this, and subscribe to our channel for more valuable tips on managing your money. Thanks for watching, and I'll see you in the next video.